good to go. Just in terms of the presentation today, summer tax webinar, I'll come on to the agenda in a moment. Myself, Simon Whiteside, tax partner, Rycroft Blent, will be speaking first, and then my colleague Anthony Main, tax director, will join me to sort of run the second half of the session. In terms of the agenda and what we're looking to cover, initially I'll just do a scene setting. Where are we? What's happened over the last 6 months? Obviously some major items are featuring at the moment. What planning opportunities are available is the section I'll then spend a bit longer on. I'll then hand over to Anthony, who will cover a bit more about what the future might hold and how this aligns to our tax planning sort of opportunities. There is, as you will hopefully have seen on the home screen, the ability to raise questions. There is a question mark icon, which you should be able to find on the banner on Teams. If you can go into that and ask a question, they will be private. You can't see all those questions, but we'll do our best to sort of run down those, send some answers around, but also deal with a Q&A session towards the end, assuming time allows. We will be running this session for just an hour, so if people have things to move on to, we'll hopefully get you away in good time for that. So moving on to setting the scene, where are we right now? So no surprise, huge global pandemic impacting significantly on all businesses, all advisors in the community helping those businesses, and at the moment a lot of effort on people surviving, and fingers crossed some businesses already, but hopefully more looking how they can come through the pandemic and flourish at the far side. Rolling back a bit further, we had a budget in the spring which made some changes, not too many thankfully, but there were some changes to things like entrepreneurs relief. I'll go on and cover that in my presentation. Yesterday we had Mr. Sunak stand up and announce some further efforts to stimulate the economy to support certain sectors slightly more than others. We'll just run through that very quickly, but that's not the primary focus of this presentation. Anthony will come on to touch on these points, but there is a lot of speculation that future tax changes will be coming in some point, especially to sort of bridge that funding gap. Clearly there's been a lot of money put out to support the economy, and everybody's expectation is there'll be a need to sort of recoup some of that money in a medium to longer term basis. Really the focus of today is to say, what can we do? What do we know about? We can crystal ball gaze a little bit to the future, but let's encourage people to do what they can now and plan effectively and efficiently. So in terms of the summer statement yesterday, I won't labour this. I'm sure you've all read the news, seen lots of information. We'll also send a pack out after this to everybody who's joined the seminar with these slides, but also with our sort of update 3 or 4 page document, just to say what sort of came out yesterday and what's impacting people with these new initiatives. But I guess just to pick a few off the slide there, there's obviously a lot of effort to support people keeping in employment after the job retention scheme comes to the end, getting new, younger employees into businesses, some support for people to take those guys on, whether it's apprentices or other sort of arrangements. Interesting stamp duty cut, really aimed at the sort of starting point in the residential market, just to get things stimulated. So some significant savings there if people can secure that before that scheme runs out. Interesting, the leisure and food and beverage sector, obviously some cuts to VAT. I guess as a tax advisor, some challenges there in terms of how that gets administered, and then an interesting sort of eat out to help out scheme, which is offering some discounts during the month of August. So that will be interesting to see how much people can benefit from that. So I won't say any more about the summer statement. I think that's really all about short-term stimulus, is just to sort of keep the economy hopefully moving out of the difficult situation it's been in. So in terms of tax planning, what agenda items are we talking to our clients about at the moment? There's a number of topics there. The first one I'll spend some time on is shareholder structuring. And by that, I think we're aiming to say, look, if individuals, families, partners are all sort of looking to invest into businesses, when we go to the front, the real start of that venture, how can they possibly do that in the most tax efficient way? And there's 3 areas covered on this slide, which are in sort of the order of priority. So if you are a strategic minority investor, a bit like an angel or some sort of other similar investor, there are significant benefits to the enterprise investment scheme, seed enterprise investment scheme, that are out there, been around a number of years, and give significant benefits to the investor on the way in, through the life of the venture, and hopefully at the end of it as well. I'll spend a bit longer on that. An arrangement that's been in place for just over 3 years now is something called Investors Relief. It sort of sat alongside of Entrepreneurs Relief for a long time, but it's come to the fore now for various reasons I'll pick up on, especially the fact that it hasn't been reduced in value. It still has a £10 million lifetime limit, so significant benefits and something that we're starting to see much more interest in. The final one there is what you would have known as Entrepreneurs Relief. The acronym now is BAD Relief, which is amusing some people, Business Asset Disposal Relief. So this is reduced as the March budget down from a 10 million lifetime limit to 1 million. So really, I guess some opportunities still to utilise that relief, but possibly in a sort of more flexible manner across possibly different beneficiaries to make sure we get as much as we can from that relief. So they're the headings in terms of the main things we look at when businesses are starting up or when investors are putting money into a venture, just to make sure we can do that in a tax efficient manner from the start. So looking at EIS relief and CDS relief, there's a number of slides here. I've left them in the pack. What I'll do is run through these pretty quickly, but as I said, we'll send this pack around and it's a bit of reading for you if you want to know about these in more detail at your own time. So really, EIS and CDS relief are interesting because as well as making an investment into a company that gives you certain treatment on dividends, capital gains, disposals at the end, etc., this relief also allows you income tax benefits when you make that subscription. So if you make an EIS investment, you're allowed 30% of the cash that goes in as an income tax deduction against your bill in the tax year you make it or the prior. Even more advantageously is CDS relief, which is at the lower end of the sort of investment range and only available for a very small amount of sort of initial funding, gives you 50% income tax relief. So significant cash flow benefits for the right investors. They can be withdrawn if the business doesn't remain a qualifying business for 3 years. As well as that, there is the ability to defer historic capital gains into your, effectively roll them over into your EIS investment. CDS investment has the same, but actually rather than just deferring, half of your capital gains tax rolled over disappears forever, so it's a permanent relief. On sale, assuming you've run the 3 years, nothing's disqualified the venture, selling those shares, any capital gain you realise will be subject to 0 CGT, no capital gains tax, so very efficient on disposal. Should the business go down, there is some ability to claim relief, and that can be income tax relief, even though you realise a loss on your shares, so that's quite beneficial. And from an inheritance tax perspective, at the moment, these shares should fall into the business property relief exemption from IHT following a 2-year holding period. So there's a number of qualifying conditions. I think this is where I'll start running through the slide, but basically these are aimed at fairly young businesses running in the UK, carrying on a trade in the UK, and for sort of privately held businesses with some of the limits set out on the screen there. There are a lot of carve-outs that businesses that are not allowed to qualify for EIS and CDS. They're to do with financial activities. Often land-rich businesses or property-rich businesses are carved out from being able to qualify for these reliefs. There's conditions about what the money must be spent on. It must be effectively spent on a business purpose and cannot be used to acquire an existing business. That's one of the main sort of caveats. And there are some limits there about how much can go into any business for EIS and CDS. As you'll see, CDS at 150,000 is generally done at sort of an early stage, probably in a round 1 funding, maybe even coinciding with an CDS and an EIS sort of funding round, all sort of joined together. Say a business needs to raise £500,000 or something like that. There's some more about eligibility. We need to be careful about connection. People cannot be connected to the business, otherwise they're you know. So it's not there for sort of family-owned businesses where 2 or 3 people connected are all sort of starting up a venture. It's not aimed at that sort of relief. HMRC can be contacted. We can secure advanced approval, but there also is a process that's needed to be followed to make sure that the company applies for the relief and shares the relevant paperwork with the investors so they can use that when they come to file their tax returns and secure the benefits. There are some pitfalls. We often come up against planning like this where something starts going awry. We can hopefully stop it, but occasionally we'll find there's a problem that's actually switched off the benefits. For example, individuals looking to secure this relief cannot have any preferential rights or pre-arranged sort of options or arrangement over their shares. That's one of the ones we often see, holding periods, changes to the business in that 3-year window. So that's the end of EIS. The next one, as I mentioned, was investors relief, which is proving more interesting in recent times. So just a few key points on investors relief. It offers a 10% capital gains tax rate. As I say, you will be familiar with that probably from prior Entrepreneurs Relief planning. It remains a lifetime limit of £10 million, quite attractive obviously since the changes we've had in the March budget. Similarly applies to disposal of shares in an unlisted trading company or the holding company of a trading group. Ordinary shares. This has to have been invested after 6th of April 2016 when the scheme first was implemented. So really April 19, just over a year ago now, was the first time anybody would have been able to secure this because we have a 3-year holding period need. But if you're going into a business now or you have some shares in a business, we can do some work to look at whether they qualify for investor relief. Unlike Entrepreneurs Relief or BAD Relief, Business Assets Disposal Relief, there is no minimum qualifying percentage. So if you took 2 or 3% of a business, you may well still be able to qualify for investor relief. Company needs to be of a trading nature. There are some restrictions on what type of ventures can secure this relief, but they are not as restrictive as we have for EIS by any means. And there are also restrictions on receiving preferential payments from the businesses I talked about with the EIS, so just need to be a bit careful. Similarly, investors relief, we need to look at sort of connections to check there isn't sort of a connection to somebody who's an employee or some other connection to the business which disqualifies. We're spending a bit of time now thinking about strategic investors who might want to take on some sort of role in the business, a bit more like your angel or something a bit further along, and how that can be done in a sort of unremunerated sort of director responsibility or something like that. So there are some opportunities there that are currently being explored and some clarifications needed on 1 or 2 of those arrangements. So business assets disposal relief remains very similar to the scheme before budget this year, before March 2020. But the main difference then is the 1 million lifetime limit. That used to be 10 million. So a significant difference. Obviously, if you're outside of BAD relief, you're into probably a 20% capital gains tax regime. So previously 10 million, significant saving at 10%, not 20%. Now 1 million, sort of 100,000 saving, but significantly less than the million we used to be able to achieve. Again, this applies to disposal of shares in an unlisted trading company or the holding company of a group. Shares, ordinary shares, there's a 2-year holding period, and within that 2 years, the shareholder must be an employee, officer or director of the company or one of the companies in the group. There's a minimum 5% shareholding requirement. That's quite broadly applied now with some of the anti-avoidance that's come in over the years. But in essence, if you have 5% of the nominal value, 5% of any exit value, that should get you to the requirements you need to satisfy BAD relief. But there's a bit of work to do just to sort of verify that. So really, I guess the final couple of bullet points there. One is looking at ownership. If we do have a broadly held business, say across a family or business partners, we do want to do more work than we maybe would have done before to make sure multiple members of the shareholder group can satisfy the criteria, so they each secure their own personal BAD relief. So if we had mum, dad, over 18-year-old, child 1, child 2, child 3, we might be able to get into a position where the shares are held sensibly across that 5-party group. The right employment director positions are held, the business retains of the right nature, so that if there were a sale, then 5 times 1 million may well be able to be secured in terms of a business assets disposal relief claim. So obviously that's the sort of planning that we're spending a lot of time talking to people about now. The final one on the slide there is to do with EMI share option scheme. I'll come on to talk a bit more about share planning and incentivisation for key staff members. But just while we're talking about the 10% rate and the old entrepreneurs relief, as before, if before the budget, no change really for this one. If EMI beneficiaries hold their share options and or shares for a minimum 2-year period, then when there comes to be an exit event, assuming those share options are triggered, converted, and the shares are sold alongside of the existing shareholders, those beneficiaries should be able to qualify for a 10% tax rate up to the £1 million limit, which is generally not really too relevant when we're talking about a number of employees. So that's a really good benefit, and staying there and having that sort of 2-year window is very advantageous. So really, I guess the sort of final investor planning opportunity that we do spend time talking about, and certainly we are looking forward a bit more at this as potentially things worsen as we come out of the COVID period. Should capital gains tax rates and lots of things go incredibly higher than they are now. People look at significant tax bills. Then individuals, families, husband and wife, whatever the situation is, actually emigrating from the UK to another location is becoming a more common topic that we're spending time talking to individuals about. Really, I guess it's all to do with, is there a value that can be realised from a business in a way in which the individual has moved their tax affairs outside of the UK and then realises that value in a way that secures a lower tax treatment wherever they land. They remain there for a sufficient period of time such that if they did return to the UK, that's permanently outside of the UK tax net. So as it says there, we have done this with a number of clients, talking to a number of clients about what this might look like. Significant care is needed about when and how you leave the UK, what sort of connections and ties you have, therefore what days you're able to return to the UK once you've gone offshore, and then obviously sort of end of that period, if you were to return, what would that look like, when and how. 5 years is the general rule of thumb to say if you can stay offshore for 5 full periods, 5 full years, then hopefully whatever you've realised offshore should remain outside of the UK. We generally expect and encourage our clients to head to a specific location, not to just become transient and say, I'll be spending 2 months a year in each of these 6 locations. That's a harder model to sort of make work. So we generally ask somebody to go and sort of stick their flag in the ground in another territory. And as I said at the bottom, the Portuguese non-habitual residence regime has been around for a number of years, has recently been sort of signed off at the EU level for a longer period with a few minor tweaks. But we've got clients that have used that regime quite effectively to go offshore and realise, significant dividends, for example, from a UK company or somewhere else and pay no tax. So there are some taxes you'll be paying there, but that's one of the more favoured regime alongside of the traditional Jersey and other sort of tax havens. I mentioned this earlier, so employee incentivisation is a key part of the conversation we have with the owners and managers of a business. Tends to be a very aligned sort of conversation. We have a founder shareholder group within a business that want to grow that business and have some key members of staff that will help them get them there. If they can work on an employee incentivisation structure with those key staff members, that will enable the founder shareholders to be diluted, but hopefully not too far on exit. Value should flow to the individuals in a tax efficient manner, which adds to that sort of dilution being the right sort of percentage. Hopefully it gives a reason to lock in those key employees, and motivate them, retain them to sort of drive towards some sort of transactional or other goal. So really the conversation needs to be sort of amongst those parties, amongst the shareholders and the sort of senior leadership team, check everybody understands what we're trying to achieve and how the motivation will apply. Often work best with businesses aiming towards growth and some sort of transactional event, but they are beneficial in other scenarios as well. Where possible, we look to the EMI scheme. This is available to most smaller and medium-sized businesses. There are some carve-outs, a bit like with EIS, for some property-rich and other sort of businesses are taken out of this. But where possible, where it's a sort of business that's owned by some private investors, we tend to find EMI schemes are the most opportunistic scheme to use. Very well trodden path, HMRC acknowledge and accept them. There's a clearance procedure, there's very standard sort of documentation process around them. They're well understood when you come to a transaction, and buyers and advisors are doing diligence on a structure. They tend to sort of stand up well so long as they've been implemented correctly at the start. If they are implemented and they work successfully, what they allow for, as it says here, and we talked about on the previous slides, a 10% tax rate to apply to the gains realised the option holders on a disposal, as long as the options have been held or converted to shares for a combined 2-year ownership period. So they're very advantageous, and I guess we spend a lot of time with businesses looking at the nuances of an EMI scheme. How do they want to run it? Do they want to sort of add some sort of extra sort of clauses to make it more focused on the individual, certain performance, certain criteria, ratchets, whatever we want to do. So within an EMI wrapper, you can put lots and lots of extra opportunities and ways to sort of tailor that for the particular needs of the business and the individuals. Growth shares is mentioned next. Growth shares, very simply, are shares which participate on an exit, but only above a certain hurdle. So if a business is worth £2 million now, we could set up a share scheme that says the beneficiaries only participate from 2 million or 2.2 million. So really they're sort of out of the money now, they're sort of relatively cheap to award from a tax perspective, but enable the beneficiaries to target on growing that business, in that example, from 2 million towards a £5 million exit target, and in that example they would share in that say 3 million sort of growth. Quite an interesting sort of tool to use, reasonably well trodden and understood by HMRC, and sometimes can be sort of sat within an EMI envelope, other times will be sitting as just plain class of shares. That's sort of covered there. So that's employee incentivisation, a key part of the jigsaw and something available we spend a lot of time talking with our clients about. Restructuring, there's only a couple of slides left before I'm going to hand over now to Anthony. So restructuring, there's a good opportunity now. Valuations might be at a level possibly with the sort of epidemic that helps support this, or certainly people look at the risks associated with their businesses in the current environment and maybe want to separate things out which are exposed in different ways to commercial risk. So lots of reasons we'll do restructuring. It could be a business that's traded currently as a sole trader, a partnership, so subject to full income tax on the owners. Would that be better moved into a corporate structure so that profits are taxed at the lower corporation tax rates and we extract whatever profits are needed to suffer some further tax, or possibly roll up some profits and grow the portfolio, whatever that might be. Trades and activities sometimes need to go into different subsidiary companies. From a risk perspective, we might need a group for tax reasons. There could be losses and profits, and if we don't get that right, they might be sitting in single companies. Might need to put them under a group to secure the benefits. Sometimes shareholders leave a business. We can do a traditional share buyback, or we might do a NewCo restructuring sort of to achieve that. So a bit of detail in there. Non-core assets, sometimes you take them out either just because it's a good thing to do or before a transaction. You'll have heard of the sort of phrase of demergers. So really we sort of talk about a company, does it need to sort of split into two companies held by the same shareholders, or possibly does that company need to go to company A and company B held by shareholder A and shareholder B? Those sort of demerger breakups are entirely possible, and there's often good reasons they are relevant. Family investment companies, I think Anthony will touch on this a bit later as well. Sometimes trading companies sell off their trade and become an investment company just by a natural evolution. Or else we've seen family investment companies created, restructured, put in place to protect family wealth, to grow up, to roll up a portfolio of profit, and really to sort of use that as a succession and wealth preservation opportunity. All of those arrangements above can be done in tax efficient manners. There are often clearances that we get from HMRC to make sure they are tax neutral, or we minimise the tax cost associated with them, but they should be on people's radars and agendas just in terms of things to do currently which are tax efficient in their nature. So I think this is the last section for me. So really it's just the sort of a bit of a statement of the sort of areas that we would hope businesses would be focused on now. Make sure we do the simple things well, make sure we secure all the reliefs that are available, especially while we need to sort of secure, tax deductions, reduce our tax bill, possibly create losses and realise benefit, and obviously in light of, maybe tax rates and other things going up. So capital allowances, do the reviews, make sure they're secured at the best possible rate and as fast as we can. Expenses, make sure they're sort of appropriately treated and claim relief where possible. R&D, I won't mention that in any detail, but it's out there, have a conversation. Secure it, especially through the SME scheme where possible. HMRC are very supportive of securing that benefit. Tax loss planning, is it in the right place? Can we secure the relief? Do we plan for when it's realised, if it's carried back, to realise some sort of refunds or carry forward? Cash extraction, do the simple things well, make sure the mix is there across the right parties, other sort of family trust environments that can be used as well as part of that. Business expenses, how are we owning properties, vehicles, electric vehicles, mobile phones, etc. And then pension contributions, you make sure that those sort of things are used in the most tax efficient manner possible. So that's the end of my section. What I was going to do now was hand over to Anthony. I think there's a bit of administration while he takes over the microphone. But what I'll do is hand over to Anthony, then hopefully I'll join again towards the end of the presentation just to deal with a few questions and answers. Thank you.
Simon, thank you very much, and good morning, everybody. Please bear with me while I try to do two things at once, which is speak to welcome you and also bring up my own slide pack, which should hopefully be on your screen right now. As Simon mentioned, this isn't a COVID-19 webinar per se or at all really, but I do think given the elephant in the room, that is the financial cost of dealing with COVID-19, that we have to accept that it will incur some level of tax cost. To put the numbers on the screen in context, pre-COVID-19, the government planned to borrow 55 billion this year to deliver on its promises. That's a stark contrast with somewhere around the 300 billion pound mark. Also, the recovery presents the government with lower tax base than forecast for the current year, with, as we heard yesterday, stamp duty and VAT receipts being reduced. Corporation tax and income tax are both expected to produce lower revenues. So we have to go somewhere to dealing with the ongoing cost of the weakened economy. The question therefore arises, how will the government deal with this? One theory is that it could all be managed through borrowing, as low interest rates could make the higher debt affordable. And if it's paid off slowly over the longer term, inflation is quite likely to reduce the real cost of debt for future generations. But that doesn't always sit well with the, well, you benefited from the COVID bailout, should future generations pay for it? However, given the Conservatives' desire for balancing public finances, it would seem likely that raising taxes, at least in the short term, will be part of the solution. Whilst tax rises tend to be unpopular unless someone else is paying for them, raising taxes now to pay for coronavirus may be preferable to cutting public services. With that in mind, the government has 4 years until the next election. They had a thumping majority at the last one, so raising taxes could be the least worst option for the government, who can always seek to cut them nearer the date of the next election when they go to the polls again. So in my humble opinion, tax rises are inevitable to pay for COVID-19. That does beg the question, which taxes are at risk? Arguably, income tax is the obvious target, a tax that's quick to change, simple to administer, bearing in mind that the majority of taxpayers suffer tax under pay-as-you-earn. It also might be more palatable to the tax-paying population than ever before. However, as you can see on the screen, it does affect a lot of people. Adding a penny to the basic rate of tax, it increases the tax take by 4.7 billion. Adding a penny to the higher rate increases tax take by $1 billion. But quite unusually, increasing the very top rate of tax is unlikely to generate much in the way of additional revenue unless we went back to the kind of 2013 50% income tax rate, which I don't think anybody really wants. One fly in the ointment, however, is Boris Johnson's manifesto promise. We will not raise the rate of income tax, VAT, or national insurance. That's a pledge that the Prime Minister reinforced when he appeared before the head of the Select Committee in May this year, and also a commitment that I've heard echoed from the Treasury in recent weeks. So presumably income tax, VAT, national insurance are no-go areas. And unfortunately, those three heads of tax raise somewhere around about 2/3 of the annual UK tax take. That said, and please feel free to call me a cynic, the manifesto promise relates, I believe, to the headline rates of income tax and employment national insurance only. So that might give us some indication of where we're heading, perhaps with banding and threshold changes to income tax. And I'd be hugely surprised if we don't see the national insurance net widened, more of which to come. So which taxes are ripe for increases? Arguably, I would say those affecting the better off. I've put up on the screen there the 5 areas that I think are most likely to change in coming months or coming years. I will run through all of them if we have time. We've got about 15 or 20 minutes. The slides are quite detailed, so I will give a high-level overview of each, and I may drop off the inheritance tax slides, but they are in your pack if you wish to have a look through them. So let's start with pension savings tax relief. Tax relief for pension contributions has long been targeted by the government, more so in recent years. For older individuals with long-standing pension arrangements, and quite often those in defined benefit pension schemes, the lifetime allowance can be problematic and may cause penal rates of tax in retirement on excess pension savings. Effectively, if your pension pot in retirement is bigger than the government feels is reasonable for you. But what has been more problematic of late is the annual allowance, which places a cap on the amount that can be saved tax efficiently each year. This has caused significant issues for the NHS, amongst others, which operates a defined benefit scheme like much of the civil service, ultimately leading to the spring budget bringing through relaxations, meaning that those with adjusted income, which is their actual income when added with their pension savings of £240,000, can now put up to £40,000 a year into their pension fund. The issue government faces is the generosity of these tax reliefs. Tax reliefs for pension contributions, for example, if a £40,000 contribution is made, it attracts tax relief for the highest earners of £18,000. Or put another way, to secure a £40,000 investment costs me only £22,000, with the government chipping in £18,000. The question I mulled over in my mind is whether the spring budget relaxations around the annual allowance give me any reassurance as to the stability of pension savings going forward, and unfortunately they don't really. I can readily see a time in the not too distant future when higher rate tax relief for pension contributions will be withdrawn in favour of probably a 20% flat tax relief. That is very familiar to those residential landlords who have mortgages, finance costs, where they too, if they were higher rate taxpayers or even additional rate taxpayers, have seen their tax relief curtailed, so they're in line with the masses. And the slide that you can see on screen, what that shows you is for somebody with a £75,000 salary making a £20,000 pension contribution, or somebody with a £190,000 salary making a £40,000 pension contribution, the differential between their current full tax relief position on the left and their basic rate tax credit position on the right. Again, just echoing, that's what the government has done when it comes to other tax reliefs that benefit higher and additional taxpayers. They've sought to level the playing field. Some planning points when it comes to pension savings tax relief. As Simon mentioned, if you run your own company, extracting profits in the form of employer pension contributions can be extremely efficient. We're always sensitive when a budget or financial statement is to be made that tax relief for pension savings could be reduced overnight. So it might be sensible, if your income this year is going to be reasonably buoyant, make your pension contributions before budget 2020, which is likely to be in November this year. Also, one final point, something slightly esoteric, protect your unused allowance. So if you have annual allowance that you don't use this year, you can carry it forward for up to 3 years, meaning in year 4, you could put 4 lots of £40,000 into your pension fund, all other things being equal. But you can only carry forward annual allowance if you were able to make pension contributions in a tax year. So my quick tip, if you don't have a pension fund, open up a very simple fund with one of the online platforms. It probably costs you £25, and that gives you the ability to make pension contributions and therefore the right to carry forward unused relief into future years. Another area that I quite like is, remember, if you have something like a self-invested personal pension, you can hold diversified assets in your retirement fund. Where this has proven quite useful in recent years to get around the annual allowance issue is, for example, using your pension fund to buy commercial land and property, and or perhaps shares in private companies. Those two asset classes can be held subject to pension scheme trustee agreement within your SIPP. You can sometimes buy them relatively inexpensively, thinking particularly in relation to agricultural land. If you have a corner of your field that might be right for development in 5 or 10 years' time, you could possibly buy it into your pension fund at a modest price, a couple of £1,000 per acre, leave it sat there, rent it back, and in 5, 10 years' time, if you sell with development value, arguably 3, 4, 500,000 pounds per acre, the appreciation in value is accrues within what is effectively a tax-free environment. One cautionary note, and I'll mention this if we have time later, is the inheritance tax restrictions that may come through in the next few years. One of them relates to pension funds, which are, from an inheritance tax perspective, extremely generous and can generally be passed inheritance tax-free because this is outside of your estate. One of the suggestions that has been made to government is pension funds, unless they're left to your wife, your spouse, civil partner, should be taxed at 10% inheritance tax, and that's something to keep an eye on. Moving on to the next subject, which I've called payback time for the self-employed, and just in case you're wondering, that background is supposed to be somebody who's self-employed under the spotlight. When the government announced that it would make grants to support the self-employed through the coronavirus self-employment income support scheme, it was a moment of sea change, I guess. The self-employed typically contribute less into the social pot as they pay lower national insurance rates, and as a consequence, they're entitled to less out. So self-employed people tend not to benefit from maternity pay or sick pay. But when the government released funds to the self-employed, they did so with a warning that those wanting to benefit from state support would have to pay in equally in the future. But what might that look like? What's the level of the disparity currently? What I've put on screen there is a couple of illustrations. The illustration on the left shows a company making £100,000 profit drawn out as a salary versus a self-employed individual making £100,000 profit. On the right, it's a slightly different position, £100,000 gross salary from a company versus £100,000 worth of self-employed profit. And what you can see is, certainly in the left-hand illustration, the self-employed individual benefits from a far greater net take-home. That doesn't quite fit on the right-hand illustration, which is perhaps a little more accurate. But what you can see in both cases is that there's a significant level of employers' national insurance. Is that what the government will target? Is the government going to try to impose some form of quasi-employer national insurance on self-employed profits? Let's wait and see. But what it might do now is it might give you the incentive or the impetus to consider operating your business in a slightly different fashion, perhaps incorporating your sole trader or partnership business into a company. That is sensible. Using a company, trading through a company, you can often avoid national insurance altogether by taking your profits out as dividend. And also with coronavirus, lower trading profits in mind, there are other benefits as I put on the screen there. Trading profits may be lower in coming years, but tax take is likely to go up, national insurance take is likely to go up. Self-employed partners and businesses are likely to be able to draw less in the way of money out of their business due to demands on working capital. And when you push all of those together, it makes operating your business through a company far more attractive. Not always the case, but it can be. What I've put on screen there is the benefit or potential benefit of incorporation. And as you can see, if we've got 100,000 profit taken tax efficiently from a company versus £100,000 worth of self-employed profit, what we end up with is almost a parity in the situation, unless and until government decides to increase national insurance on self-employed profits. Another way to achieve higher national insurance receipts is to reduce the number of people who are eligible to be taxed as self-employed, which brings me on to the hot topic, the hot topic of IR35. It's been a hot topic for about the last 20 years. As you can see from the screen there, IR35, which a lot of people think is a very new piece of legislation, has actually been with us. It was announced in 1999, went on to become effective in 2000. Nobody really did anything with it until about 2015, when government said enough's enough, we're going to force you to think about IR35, rolled out into the public sector, which didn't have an option in 2017. And what the IR35 legislation does very broadly in something of a cack-handed fashion is it seeks to tax those who work like employees as if they are employees, which, as seen in the previous slide, can significantly increase the national insurance for the employer or deemed employer. These rules were due to be rolled out into the private sector this year against huge revolt. Perhaps one of the good things that came from coronavirus was a one-year deferral of IR35 in the private sector, which has given time for people to really start questioning whether we should see it rolled out at all. The House of Lords Economic Affairs Finance Bill Subcommittee is vehement that we shouldn't have IR35 as it stands. They accept that in principle IR35 legislation makes sense, however, it just doesn't work. The IR35 rules as they stand are already causing unintentional behaviour. For example, clients disengaging, terminating contracts with their workers, contractors moving overseas where the tax regime is more friendly. Everyone struggles with the status determination process for IR35. HM Revenue and Customs check employment status tool is deficient. There are other inequalities. Historically, both clients and contractors have benefited from IR35. Going forward, it's typically, or in the public sector so far, typically, it has been the contractor who has lost out as a result of incorrect status determinations. And being taxed as a deemed employee doesn't bring with it any of the standard employment rights, such as unfair dismissal, holiday pay, etc., etc., etc. It's not inconceivable that revamping IR35 legislation could be the opportunity the Chancellor seeks to categorise even more people as employees, thus drawing them into the Class 1 national insurance net. Right now, there's no change. The House of Lords has asked government, or has insisted government, make an announcement by October 2020 as to whether the April 21 rollout of IR35 in the private sector will go ahead. The biggest loss to the Exchequer is in national insurance, particularly employers' national insurance. So I have seen some chatter coming out of Treasury that they may simply ditch IR35 altogether, both in the public sector and private sector, in favour of something like a quasi-national insurance charge on revenue, so turnover, or even a national insurance charge on private company dividends. Watch this space. There's no planning right now, but medium and large businesses will need to be careful to ensure that they have a viable workforce. Many, but not all, will have prepared in the expectation of IR35 being rolled out into the private sector in April just gone. But for now, those who haven't, you must make an impact assessment as to how IR35 would impact upon your business. The next area that I think is at risk is capital gains tax. Capital gains tax only paid by the wealthy. The government's plan to improve infrastructure in the north of England has proved popular, and so might the idea of funding this by raising tax from more prosperous parts of the country. We've heard rumours of wealth taxes, such as a mansion tax, and we heard those before the spring budget, before coronavirus. But much less controversial would be an increase in the capital gains tax rates, which in practice, and in fairness, are only paid by those with higher incomes and the ability to save. Capital gains tax rates are at an all-time low. We've already seen the government take steps to increase capital gains tax revenue in the form of a 10% capital gains tax surcharge on residential property gains, the Entrepreneur's Lifetime Allowance of £10 million becoming bad relief of £1 million, and accelerated reporting and payment of capital gains tax on residential properties. So what might the options be in terms of increasing tax rates? Well, the government has been recommended that it should increase the capital gains tax rate so as to align them with income tax rates. So 20%, 40%, 45%, depending on what level of income you have. Other than bad relief, capital gains tax rates could be increased by 10% across the board, so as to become 28%, sorry, 20, 28, 30 or 38%, or even setting a single capital gains tax rate of 28%. The other thing that has been raised is that those who can generate tax from wealth can use effectively two nil rate bands or two personal allowances, one for income tax and a second capital gains tax exemption on wealth. That can save up to £3,400 per person per year, and a married couple can double that up if they need to by exchanging assets tax-free between them. What might the capital gains tax changes look like? Obviously, across the board, capital gains tax rates increase. A couple of illustrations there of £100,000 gain with the calculation as is, aligned with income tax, 10% plus, fixed at 28%, and then also on the right-hand side, without the benefit of the additional capital gains annual exemption. Some planning ideas. Capital gains tax changes can happen overnight. So if you have transactions in the offing and it's commercially sensible, bring them forward. Trusts, if your assets are depressed in value, consider appointing them out to beneficiaries. It may sound niche, referring to offshore trusts. They were exceptionally popular in the 80s, and many of them are now being unwound, and beneficiaries of offshore trusts need to be acutely aware of the supplemental charge to capital gains tax, which increases the capital gains tax rate by 60%. When you're structuring investments, do it with tax in mind. So as Simon said, bad relief, investors relief, EIS, SEIS. Make use of rollover and holdover relief. So when you're selling business assets, or if you suffer a compulsory purchase on a residential let, you can roll those gains over. If you have multiple homes, make principal private residence elections to determine yourself which is to be tax exempt. Monitor that going forward. Transfer assets between spouses to ensure gains are taxed in the most efficient place. And as Simon mentioned, tax motivated emigration. Now, Simon mentioned Portugal, Portugal's NHR for tax motivated emigration. Portugal's not a great place for capital gains tax per se. There are alternatives, however, such as Malta, which is my latest favourite for capital gains tax. Along a similar vein, thinking around investment, a return on wealth, I do wonder whether we might have a revival of the differential rates of tax for companies. The current low rates of corporation tax, are seen to give the UK a competitive edge. So would the government really want to risk that? Probably not, but the differential rates of corporation tax could really benefit the government when targeting them towards investment companies. What do I mean by an investment company? Well, I'll come on to that in a second, but harking back to probably pre-2015, if memory serves, UK corporation tax had been charged, since 2015, corporation tax has been charged at a flat rate, save for certain specific areas such as oil and gas. Whereas previously there was a small companies rate payable by companies with profits of under 300,000, set against a standard rate of corporation tax close to 30% for larger companies. At that time, the standard rate of 30% corporation tax was always paid by investment companies. So why might the government be thinking about that now? Well, if we hark back to the 2015 budget, Spring Budget 2015, the introduction of rules pertaining to residential landlords' finance restrictions, they were introduced to fill a black hole in the Treasury to free up some housing stock. However, because of the ability to incorporate rental businesses, that didn't happen. They are effectively propcos, property companies or investment companies by another name. Also, government might consider targeting corporation tax towards investment companies because of the perceived benefits of family investment companies, which Simon touched upon. Are there any planning points here? Not really. Be aware of the risk. If you're looking at a property company or a family investment company, look at them in the round and over the longer term. Stress test the benefits and consider alternative options. Given that I'm running out of time slightly now, I'm going to skip over the inheritance tax notes here. They are, or they will be in the slide pack that I share. What I'm going to do is drop into my summary to give you some points to think about, covering off things that Simon has discussed and things that I've discussed. Work within the tax regime. We know it now, we understand it today. Many of the opportunities that Simon and I have discussed are government-backed schemes, so EMI, EIS, SEIS. They offer guaranteed tax treatment, and those specific schemes are unlikely to change overnight if more generic tax legislation were enacted. Look to all available flexibility. There's often more than one way to secure tax savings. Don't ignore what appear to be modest tax savings. Keep it simple if you can. Think ahead, plan in advance. Think about investment, tax-free or low tax returns, business restructuring, your transactional activity. Workforce planning is key. Quasi-self-employed IR35 issues, employee incentivization and retention, particularly in the current climate. Business succession, if you've got a sensible plan, if you can draw one up, use it sooner rather than later. Where possible, accelerate transactions before any substantive changes. That's particularly important when it comes to revenue taxes, so your income and corporation tax, which are easily changed, and capital gains taxes. Changes don't always happen during a tax year. They do, and they have. Large-scale reform of inheritance tax shouldn't happen without consultation, hence why I felt comfortable not running through my inheritance tax slides in detail, but have a fallback plan just in case. Be aware of key dates: autumn budget 2020, spring budget 2021, a coronavirus emergency budget. Closing out on what I wanted to say, doing nothing is a gamble. If you've got a plan, use it, think ahead, and take advice. And at this point, I'm going to drop back and welcome Simon to deal with any questions that our audience has raised.
Anthony, thanks there. Sorry, we've had a few IT gremlins, so we're going to leave you on screen and I'll just join in. Hopefully people can hear me as well now. We've only had a couple of questions in, so we'll rattle through those pretty quickly and then we'll close down in good time for the 11:30 deadline. One question we've just been thinking about is, somebody mentioned the stamp duty change. Obviously £500,000 sort of limit before which stamp duty applies. Second holiday homes and all those kind of things, second properties where we get the 3% surcharge. We've done some digging around. My understanding, Anthony, I don't know if you've seen anything differently, is that will still apply. So you won't be at 0, you'll be at 3% on those transactions. I'm not sure if you've seen that anywhere.
Yes, I have. Indeed, last night I was checking a few positions for ongoing transactions that I'm involved with, and that certainly seemed to be the case. HMRC updated immediately their stamp duty land tax calculator, which reinforces that the 3% surcharge is still applicable. So in theory, for your £500,000 band, you have a nil rate plus your 3% surcharge. So yeah, second homes, multiple properties, holiday homes, still 3% surcharge.
Okay, thank you. Another one that's just on the list just to walk through is to do with EIS and CDIS, and I think this is more speculation or encouragement. I guess from the sort of sector and the sort of VCT type community, there's some suggestions there that actually one way the economy will be sort of started up and encouraged is to invest in these type of, risk-based companies. So, would some of those rules be relaxed a bit, the 7-year window and all those kind of things? So, I mean, I guess that's probably one to flag for the future, part of your forward looking, maybe the autumn statement. And if you had any thoughts on that topic as well, Anthony?
Not hugely, but I did see yesterday that the Venture Capital Trust Association was banging the drum very loudly for those exact measures. Companies that have existed and traded for longer, so no 7-year limit, and also those companies with larger workforce. So certainly something to be very, very aware of. Hopefully we'll see some positive moves in that respect.
Yeah, I mean, one move that's been around now for a little bit of time is the change to sort of give slightly better reliefs, whether it's higher limits or longer time span for sort of knowledge intensive businesses. They tend to be sort of heavily research oriented and there's a reasonably narrow definition, but that's a relaxation that's there for some businesses that still qualify for those reliefs. Just the final one I had, Anthony, you jump in if there's any more you want to sort of bring out to people. We've probably only got 3 or 4 minutes left. Emigration, what might that involve? What might the benefits be available? Do you want to sort of add a bit more in that while we just got these last few minutes to spare, Anthony?
Yeah, sure. So emigration, or more to the point, tax motivated emigration is something that we've done quite a bit with recently. Depending on which jurisdiction, or sorry, depending on your tax issue or tax problem, there are various jurisdictions around the world. I have to reinforce they're all whitelisted jurisdictions. So we're not sending anybody off to Panama for the avoidance of doubt. We don't do aggressive tax planning. They're all whitelisted. But various jurisdictions around the world offer different tax incentives to attract individuals to their territory. So typically, things that we've been doing recently, Portugal's non-habitual residence regime is very attractive to individuals who generate income outside of Portugal. So typically, we might see somebody who has operated their trading company in the UK for a number of years, rolled up a significant amount of retained profit within their company. They have the opportunity, for example, to relocate to Portugal, subscribe to the non-habitual residence regime, declare dividends from their UK-based company. The dividends in the UK do not suffer tax in the UK, and Portugal, because of the double taxation agreement, doesn't seek to tax in their jurisdiction. So that's one way of extracting profit from your company in a highly tax efficient way. You do have to be very careful, however. If we look at Portugal as an example, it's not such a beneficial territory when it comes to things like capital gains. They do, as I recall, seek to tax capital gains from outside of their jurisdiction. But I'm currently working with other clients who are looking to relocate to, say, Malta, who has a very friendly tax regime when it comes to new residents realizing capital gains outside of their territory. So it's a very good option. But what I find is 9 out of 10 clients, or maybe 7 out of 10 clients I talk through tax motivated immigration with, might actually take a step back because it's quite an upheaval, having to spend at least 5 years settled outside of the UK with relatively restricted visits back. It generally comes down to weighing up the tax benefits versus the downsides of being restricted in your movements and return visits to the UK. Yeah,
I'd echo that, Anthony. I think I've had many conversations where we haven't sort of gone over the line, but we've sort of had a good look at it. I guess the only thing I would add is that depending what comes through in the autumn or the next 6, 12, 18 months, it might well sort of jump back up on people's agendas, obviously depending how the regime in the UK evolves over that period of time. Yeah, I'd agree with that. Great. Well, we're just probably coming up to the end of the hour there. I don't think there's any more questions we have. As I said at the start, thank you very much for joining. We will be sending around a copy of the slide pack and our sort of overnight summer budget announcement. Our contact details are on screen there. Hopefully a lot of you will know us already. If you do have any follow-up questions, we'd be delighted to pick those up directly with you. Look forward to catching up with you all soon. Thank you. Thank you. Bye.